All right, folks, housing market update. Some interesting things going on right now in the market. Let's get into it. So what can we learn from recent existing home sales numbers? Some interesting data has come out. Sales of existing homes of all types, from single family houses, condos, co-ops, were down about 2.3% year over year in September, the second month in a row of year over year declines, and we're down 6.5% from the peak in October last year, according to data from the National Association of Realtors. But when we compare it, when it's compared to the prior month, sales rose about 7% to seasonally adjusted annual rate of sales of 6.29 million homes. Check out this chart. We look at look at year over year single family houses sales fell, condos and co-op sales rose a little bit. Sales of single family houses at a seasonally adjusted annual rate of 5.59 million houses were down 3.1% year over year, the third month in a row of year over year declines, and the biggest year over year decline since May 2020, and down 7% from the peak frenzy in October of last year, as we all remember. So when we look at condo sales at seasonally adjusted annual rate of about 700,000, condos were still up 4.5% from last year, but it was the smallest year over year gain since June of 2020. So look at this chart of year over year percentage changes in total sales. Shows the blistering boom in home sales last year and earlier this year, and how the boom in sales has now lost a little steam. So fear of higher mortgage rates, there is a well-established phenomenon at work. According to Freddie Mac, the average 30-year fixed rate mortgage in mid-August came with a rate of about 2.87%. and at the end of September with a rate of 3.01% in the latest reporting week. So, the rate rose to roughly 3.09%. So during the early phases of rising rates, such as now, buyers try to lock in a rate before they rise even more, which leads to a rush in home sales, and then turns into a decline as rates rise further. But even with this rush, sales were still down 2.3% from a year ago. This will be particularly interesting this time around, since prices have shot up so fast last year and earlier this year that even small increases from record low mortgage rates will put even more affordability pressure on the market and snap some demand, most likely. So seasonality returns, pandemic frenzy begins to fizzle a little bit. The median price fell for the third month in a row in September of August to about $352,800 for all types of existing homes combined. Condo median prices fell for the third month in a row to $297,900, down 4.2% from the peak. September, it was roughly 2.2%, August 0.5%, July roughly 1.5%. So single family house median price fell for the third month in a row to $359,700, down 2.8% from peak. And September was 1.4%, August 0.5%, July 0.9%. So declining prices in September are, they're not unusual right now at this time of year, but last year's seasonality was totally upended when prices spike no matter what, as you can see in this chart below. Take a look at that. Reverting to the seasonality is the first step back from craziness toward what is now called normalization or decelerization. So the price decline further reduced the year over year price gains for all homes combined to 13.3%, down from a year over year gain of 23.6% during the peak frenzy in May, roughly around then. So maybe Zillow, when it decided to stop buying houses for its flipping business, saw something in its massive pile of data. Those algorithms, it's a little more difficult to flip right now. The frenzy is gone, but they're putting the brakes on and taking a break, as you can see. So new listings normally peak in May and then drop off through December to January, after which they begin to rise again. The pandemic has totally upended any seasonality last year. This year, new listings rose from very low levels in December through June, flattening in July, and started dropping in August and September. The green line indicates the movement between September data, and this is looking at Realtor.com, residential listings database. So the share of all cash sales rose to 23% of total sales in September, but roughly in the same range as during the summer. Cash buyers included, of course, institutional investors that can, borrow at the institutional level, plus individual investors and second home buyers that have cash or can temporarily borrow against their portfolio and get a mortgage later. So the share of sales to individual investors and second home buyers dipped to 13% in September from 15% in August. The mortgage rates rose at the 10-year Treasury yield jumped. The Fed has now made clear that it will taper its asset purchases after the FOMC meeting in November and end QE entirely by mid-2022. They are already, the Fed governs that are considering to speed up the pace of tapering to make room for sooner rate hikes. Get ready. The $120 billion a month in QE, which includes $40 billion a month in mortgage-backed securities, was designed to, repress long-term interest rates, including mortgage rates, and a massive manipulation of the credit markets. And the end of QE with the single biggest relentless and predictable buyer gone will give credit markets a bit more leeway to respond to surging inflation and higher yields. The 10-year Treasury yield has surged by over 60 basis points since early August to about 1.67% at the moment. Mortgage rates, which generally lag Treasury yields, have risen about 32 basis points since early August to about 3.09%, according to Fannie and Freddie Mac's data released. But as you can see, mortgage rates remain extremely low with a lot of room left to go up, and the Fed hasn't started the rate hike cycle just yet. They still might put the brakes on. So the first thing is that the demand for single-family homes is still enormous, despite more than a year of booming sales. Existing home sales were up 7% compared with a year earlier. The median price of previously owned homes was about 13.3% higher than a year ago. So, it's also worth remembering that this is an abnormal return on investment in a house over time. Housing tracks the growth of the economy and the rise in prices generally. So double-digit gains are not sustainable and typically are a sign that people have decided that they are, they're going to divest in housing. So to kind of put it another way, when you have a double-digit gain in your home price followed by a double-digit gain a year later, which is what we're seeing now, you should expect the housing market to start to slow down a little bit. And indeed, that is what's happening. The year-over-year price gains are falling each month. And that's basically, a sign of a healthy stabilization. One thing that has been largely overlooked in the better than expected September home sales is the correction to the worse than expected starts numbers. So normally rising homes and existing home sales should feed into rising starts. Builders see a high level of demand for houses and so they build more, right? But we're living in an age of supply chain crisis right now. It's unprecedented, and so builders are reluctant to, pay up for materials and labor. They're taking a break. So that matters for the economy. It means that rising home prices and rising home sales do not necessarily translate into economic growth. Selling a home that was built 10 years ago doesn't add to the GDP, but building a home does. Supply chain disruptions slow growth, and that is a big problem right now. When we look holistically at the world, China, Japan, Russia, they're not having the supply chain issues that we're having. We got 75 ships sitting off Huntington Beach and Long Beach, container ships. So this is a major problem, and it's going to kind of translate into, you know, the housing, because it affects materials and builders and these things. So that's a top line review of the housing market. Things are still looking good. Rates are still low, and it's still competitive out there. But we've had this double-digit growth over the last year and a half, 2 years, and there's going to be some correction right now. It's still early. Keeping an eye on the forbearances, the evictions. You know, it's still early there, and you know, we have the defaults are up throughout the country, but it hasn't translated in an abnormal housing market yet. But it's early. So there's the top line numbers. Have a great week. Take care.